In the world of finance, every number tells a story. But not every number holds the same weight. Some mistakes are minor, like finding a penny in $1 million vault. Others are so significant, they could change the entire picture for an investor. This is the essence of materiality. ISA 320, materiality in planning and performing an audit is the standard that guides an auditor's judgment. It's the North Star that helps us determine what's truly important, what misstatements could influence the decisions of financial statement users. It's not a rigid rule, but a flexible concept that requires a blend of professional judgment and quantitative analysis. So, what exactly is a material misstatement? A misstatement is considered material if it, either individually or in the aggregate, could reasonably be expected to influence the economic decisions of users made on the basis of the financial statements. This isn't just about the size of the error. It's a three-dimensional concept: magnitude, or size. How big is the number? A $1,000 error might be immaterial for a multinational corporation but could be catastrophic for a small startup. Nature. What is the nature of the error? An error that changes a profit into a loss, or that relates to a fraudulent transaction, might be material even if the amount is small. It's about the quality of the information. Context. The circumstances surrounding the misstatement also matter. An error that affects a key loan covenant or a bonus calculation could be highly material to stakeholders, regardless of the dollar amount. To apply this concept in a systematic way, auditors use a tiered approach to materiality. Overall materiality, this is the big picture. It's the maximum amount of misstatement that could exist in the financial statements as a whole without influencing the economic decisions of users. We establish this at the planning stage of the audit. We typically use a benchmark, like a percentage of a company's revenue, total assets, or profit before tax. The choice of benchmark depends on the company's specific situation. Performance materiality, this is our safety net. It's an amount set at less than overall materiality to reduce the likelihood that the aggregate of uncorrected and undetected misstatements exceeds overall materiality. It's a critical component for risk assessment. By setting performance materiality lower, we ensure that even a few small errors, which are individually immaterial, don't add up to a material misstatement for the financial statements as a whole. Specific materiality. For certain accounts or disclosures, a misstatement of a smaller amount than overall materiality could still be material. For example, a legal liability disclosure or a related party transaction might be sensitive to users. In these cases, we set a separate, lower materiality level, known as specific materiality. Materiality isn't a one-time calculation, it's a dynamic concept that's used throughout the audit. Planning. As we've discussed, we first establish overall and performance materiality. This guides our audit strategy and the scope of our procedures. We use these numbers to determine the sample sizes for our testing. For example, if we're testing accounts payable, we only need to test transactions above the performance materiality threshold. Execution. As we perform our tests, we accumulate misstatements. We keep a running tally of both corrected and uncorrected misstatements. We constantly assess whether the sum of these misstatements is nearing our performance materiality level. If we find more errors than we expected, we might have to revise our initial materiality levels or expand our audit procedures. At the end of the audit, we evaluate the aggregate of all uncorrected misstatements. We ask ourselves, does this total amount, considering the context and nature of the misstatements, still allow us to provide an unqualified opinion on the financial statements? If the answer is no, the client must correct the misstatements. In essence, ISA 320 is the framework that allows auditors to be efficient while remaining effective. It helps us focus our efforts on what truly matters, ensuring that our audit provides a reliable and meaningful opinion to the users of the financial statements. Thank you for watching. Follow for more similar content.